So there's two types of taxpayers. There is, from an accounting method perspective, what kind are they?
Cash and accrual.
Cash and accrual. Cash, when do you pick up the income and take the expense?
When you get the cash.
When you get the cash. What about accrual? Can you express when an accrual method taxpayer pulls in income and pulls or takes the deduction?
So for an accrual method taxpayer, you get the income when you earn it. You don't have to receive the cash yet.
Yep.
And you can expense it. You can accrue for expenses that you can accurately plan and calculate in the future.
Okay. So the fact that I can accurately plan and book it on my financials is that everything I need to measure in terms of being able to take that deduction.
No, I believe there's 3 parts.
And what are those 3 parts?
I'm trying to recall that.
Phone a friend.
Let's go, Chris.
So the first one was the all events test. And the all events test talks about essentially all events have occurred to establish this liability.
Yep.
Second one is, like Matt said, you can easily determine the amount of the liability.
Yep.
And then the third one talks about economic performance.
Yep. And which of those 3 is the hardest?
Economic performance.
Okay, economic performance. And why is that of the 3 the hardest?
I mean, it's 2 prongs. So if it's goods or services, it's when the goods have been delivered or when the services have been rendered. And then the other category is harder to think about.
It's not harder to think about. It's actually easier to think about. It's just harder to quantify.
Harder to quantify.
It's when cash is paid.
Yep.
Like going back to the GE tort liability where they were sued for $30 million, you can't take all events have occurred. It's quantifiable because the judge says you owe $30 million, but we're not giving you that deduction until paid. And there's categories that come along those lines, okay? Actually, you're almost that close to a gift card. I mean, that was pretty good. How you guys feel? Should I give him a gift card for that?
Be nice to me.
Allie, why are you shaking your head no? You know what? That deserves 2 gift cards. That is true. Did you really make it take a shot?
Yeah.
And you complied?
Great cheese, yeah.
Okay, you get 1 for taking the shot. Okay. So let's see. Chris, who you want to call on?
Matt.
No,
They're doing it.
we are not going to do it. Are we going to call? Okay, I'll let this stand for
All
a
right.
little while. We'll see what the hell happens.
Okay.
Is this because you went to bed at 9?
I didn't go to bed.
What time do you go to bed there?
Like 10:30.
10:30. Okay. What's 16 say, Matt?
16 says application of the all events test to accrued expenses. So you have your vacation accrual. Economic performance is when paid, and there's relief that allows payment within the first 2.5 months of the next year.
Okay, so specifically with accrued vacation, it says all events. You know what your vacation accrual is at the end of the year. It's a fixed liability because we know what it is. We owe it to you. If you leave the company, I think Nebraska requires us to pay you that out. So it's a known liability that we have to pay. So the first 2 prongs have been met, correct? So the second piece is, well, wait a minute. Accrued vacation says economic performance has to include payment versus a good or service being provided. Because you as an employee, you provided your good or service by doing a tax return or whatever it is that you're doing, correct? So it almost falls under that category. But when it comes to vacation, they say, no, we're not going to allow you to take that full amount because you may not take vacation. You may be a hard worker or think that we're going to fire you or whatever it is that you're thinking to do that. So let's see. If I know my vacation accrual is $100 at the end of the year on December 31st, Do I know what my amount of deduction is? I do.
Yes.
Are you sure? Read it again.
No, because it has to be paid within the next 2.5 months.
Has to be paid in 2.5 months. Brett, do we ever shortcut? Do we ever go, how often do we go to the client and say, okay, give us an exact reconciliation of what you paid? How often do we do that?
Maybe not as much as we should.
Maybe not as much as we should, but do we do this mathematically?
Yes.
We do. Okay? So what we do is we take this divided by 12. We're going to make that 120 just because that's going to be easier. Which gets 10, right? So now I have the number of months times 2.5 is 25, right? 0.5. 25. That is the amount. So when I have my income of 1,000, I know embedded in that 1,000 is $100 worth of vacation accrual, or 120. So I add back the 120 because I got to back out my GAAP accounting, and then I have to I got to back out my GAAP, and then I got to take my tax, M1, of 25. So now we're at 1095, correct? Is that math right? Does that make sense? So it's when paid. Economic performance with respect to vacation accrual is when paid for the first 2.5 months. Who would you like to call on?
Max.
What's the next thing? Say Max.
Accrued bonuses. Economic performance is when paid. There's relief that allows payment within the first 2.5 months of the next year. However, the mere accrual of the liability does not meet the all events test. This also has a requirement of being reasonable, estimable. If bonus is discretionary, it is not deductible until the year paid. If the company says there is a bonus, but will be determined once the financial results have been completed. In other words, at the discretion of management, bonus amounts will be set when the financial results are clear. If the board or management set the bonus amounts at 12/31, then the reasonably estimable standard is met. And then if the board or management set the bonus as a percentage of financial results, then the reasonable estimable standard is met.
Okay, so let's talk about what that means. Brett, do you know this rule? I think so. Okay, that was being sincere. I wouldn't. Okay, so when it comes to bonus accruals, okay, I'm going to just say on one side, you just have the straight up accrual of $100. And then I'm going to put the second one, determined after year end. And to me, as a staff person, you probably want to highlight this piece to be able to ask the question of what, because we didn't highlight vacation accrual because it's taking the vacation accrual divided by 12 times 2.5. That's a constant, that's a linear. You can commit that rule to memory. This one is a little bit different. This one says, okay, I accrue a bonus of $100 at the end of the year, but then there's this other piece that might be determined by profits. It might be, well, we're going to do our GAAP financials. Well, I got to figure out exactly where I stand after year end. There's lots of analysis I got to think about before I set that bonus. The IRS says, well, wait a minute. The more nebulous that is, the more we're not going to give that to you as a deduction. Okay, so this is two categories, determined after year end and accrual. So I know I'm going to give Max a $100 bonus because he was a good employee all year. That, there's no doubt, I owe him the money. I've accrued it, it's on the balance sheet. I print a 1231 balance sheet, it's there. Everybody knows it's there. But then I say, Matt, who evidently is going to be insufferably picked on for a little while, is we're going to see how much picked on he gets to figure out how much his bonus is. Is he going to get picked on 4 times, 10 times, 20 times? What exactly is going to happen to poor Matt here? Okay? So the bigger that bonus number is, the more he gets picked on, the bigger the bonus. Okay? But I now have to figure out, what is it, $1 per pick on? Is it 100? Or what is it? And I'm going to talk about that after year end to see how he is, because I don't want Matt to leave and he's going to suffer, so I got to counterbalance it. Okay? So, at the end of the day, the more it's not fixed, the more the IRS is going to push back and say, you don't get that. Have I ever seen that on an exam, Matt? IRS exam. There's only one answer.
Yes.
Yes. The IRS is in tune to this issue. So if you say, well, you know what, I got to figure out if I got $1 million of income or $2 million of income or $3 million of income, and then I am going to make a determination of how much that bonus is. That determination is coming after year end, after our auditors come in and make all their adjustments and do everything they're supposed to be doing. So the more it's like that, the more they're going to disallow that, and economic performance in this 2.5-month rule doesn't apply. But if I say, you know what, I have a formula, and that formula says, and it's board approved, board agrees to what's going on, I'm going to take 10% of my GAAP net income, and I'm going to pay that 10% out. Okay? So now at 10% of $1 million is $100,000. Now I know I have a bonus accrual of $100,000. So then the next question really turns on, well, I got $100,000. Am I going to give that to, now if I don't determine, I'm going to give 10% of that to Matt, 20% to Jackson, and who that percentage is going to, the IRS would possibly push back and say, well, you've determined the amount, but you didn't say who it was going to. So they pick on they pick on this piece. So as a staff person, when you see the accrual, one of the questions that you could possibly ask, and I guarantee it'll blow the manager's mind, because how often have you been asked this question?
Not very.
Not very. But this is a real issue that you could say, hey, is all this bonus, was it truly fixed and determinable at the end of the year pursuant to, did the board make a recommendation? Was it formula? Was it a hard number? What was it? Okay? So that is a question that's worth asking. Let's see. Does all that make sense? Yeah.
So could companies set at the end of the year we're going to give X% and it's going to go to these 5 people to meet the standard of reasonably estimable and then change it?
What do you mean change it?
We said we were going to give it to these 5 people, but we don't really know because we just wanted to meet the requirements so we could take the deduction, but actually we're going to switch it and give it to these 3 other people. And
you're a CAS person, right?
Yep.
You think like a tax person. So this is the real way that happens, okay, and we'll cut this piece out. Don't cut it out. I don't care. Is what might happen is, all right, look, I don't know what the bonus is. And I'm waiting until I figure it out. Okay, whatever. Don't talk to me about it. I don't need to know what you do behind the scenes. But if you have board minutes, wink, that say that you gave the bonus, wink, and the board minutes are dated December 31st, wink, am I going to question when that actually happened? Probably not. So if they have the documentation in place and we can produce it contemporaneously with an audit, no problem. So, but we aren't going to audit whether they are doing that or not. But we might have said, hey, you got board minutes, don't you, on an IRS? Oh, you bet we do. Here they are. So it does happen, maybe. The world's maybe not as honest a place as you want it to be. Let's see. Who was the last person? Is that you, Max?
Yes.
Matt, who do you want to call on?
Let's go Connor Boykman.
Who? Oh,
Connor.
Bad debt deduction. One, economic performance is when the AR is specifically written off.
Okay, so I assume everybody's in tune with what a reserve is. So I'm going to bill $100,000 a year. I know on average 10% is bad. And you see this specifically, which I'm not even going to talk about that. I know 10% is bad. So 10% of 100,000 is 10,000. So debit AR, 100,000, credit income, 100,000. I know 10 of it's bad. I don't know who's bad, but I know 10 of it's bad just based on experience. So I'm going to credit AR for 10 and debit bad debt expense for 10. In that case, I don't know who the bad AR is. The IRS says you can have a reserve, but we're not going to allow you to take that as a deduction. So a bad debt reserve is not deductible for tax until one of two things. You actually say, I'm writing off this AR. Brett Holtzen isn't going to pay me the 10 grand. He happens to be the guy that didn't pay it this year. So I write off that AR. That's the moment I can take it. Or, you know what, my bad debt experience isn't 10%, it's 5%, and I reverse that out and take my reserve down from 10 to 5. Those two instances, that would have a P&L impact for tax for write-off purposes. Okay? Depreciation, we talked about yesterday, correct? Gain loss on the sale of assets. Let's see. Carter, what's my definition of proceeds, just so we know where we're at?
Cash, property, and then debt relief.
Cash, property, and debt relief. So, can Allie, when I say there's a difference between gain loss on the sale of fixed assets, can you articulate why there would be a difference in gain loss for fixed assets for tax versus GAAP?
Probably your depreciation, like book depreciation versus tax depreciation.
Okay. Is everybody on board with that concept? Do we need to go over that concept? Okay. And if one person said yes, we should stop and do it. Okay. But everybody seems comfortable with that concept that my book depreciation was $100 on my $1,000 asset. My tax depreciation was $1,000 because I got bonus depreciation. Now they have a GAAP basis net book value of $900. Tax net book value is 0 because I took 100% GAAP or tax bonus depreciation. So my basis for the calculation of both those is different. Therefore, I'm going to have a different gain for book purposes than I am tax. That seems like a solid concept in the room. Yes? Okay. Deferred compensation. Allie, who you want to call on? Oh, okay. Let's see. Luke, go ahead.
All right. Deferred compensation. So you got three options. Non-qualified stock options, where economic performance occurs when this is paid. GAAP writes these off over time. And then ISOs. Googling is a good thing. This is a multi-level decision tree. There are qualifying and non-qualifying dispositions that dictate the treatment. And then deferred compensation arrangement. Economic performance occurs when this is paid, and GAAP also writes these off over time.
Okay, so here's the punchline. Okay, for non-qualified stock options and deferred comp, it's written off today or as paid. So, who you want to call on, Luke?
Matt.
Matt, do you know? Can you describe the taxability or what happens with a stock option?
Isn't it taxable when received and then
Can you tell me what an option is?
a stock
A
option?
compensatory stock option, non-qualified compensatory stock option. Because this is worth knowing.
I have an idea of what it is, but I don't believe it's the right answer, so I'm gonna say I don't know.
Okay. All right. Who you want to go to?
Let's go with Sam.
Sam, do you have a shot?
Kind of similar boat.
Okay. Does anybody know anything about an option? Okay.
Isn't it like after a certain point in time, they get the option to buy a stock at a certain price that would be more beneficial than like the market price?
Well, that's the only time you would do it, but yes, that's exactly right. Okay. So you say in order to put incentives to keep people around, Lutz would issue Jackson an option to buy shares in Lutz. I'm going to pretend today's price for Lutz is $100, and we say, Jackson, if you're here 5 years from now, we will give you the option to buy Let's stock at $100. We don't care if it's $101. We don't care if it's $1 million. We're going to let you buy that stock for $100. Okay? So Jackson's here 5 years later. Brett has provided excellent leadership, and we've gone from $100 to $500. And we're just going to refine it to one share just for ease. Okay? Would you want to buy a stock that's worth $500 for $100? Yes. Code section 61, does anybody remember what that says? What you got, Luke?
Is that like what income is?
Anytime you have, yes, income. It defines income. So anytime you have an accession to wealth, 61 says, unless there's an exclusion, it's income. Did you have an accession to wealth? How much?
I got $500 of value.
Yeah, but how much did you have to pay for it?
Oh, sorry, 100.
100. So there's $400 of accession to wealth. So on that stock option, we would give him $500 of stock. He pays us 100. We now give him a W-2 for $400. Okay, and that $400 is now goes through his W-2 and it's now subject to withholding. And since we gave him the 400, it's going through his W-2. At that moment, that's when we have that that M1. Hold on, I'm going to make one more point. So GAAP purposes, they would say, okay, that option, that $100 option, they do something called a Black-Scholes calculation to say that option when issued is worth $150. So the company takes a $150 deduction in year one, or however they do it for GAAP. This is going back to Austin yesterday, saying, don't reinvent the wheel. Ask the auditors how they're taking that option expense into GAAP expense over time, so you know what your GAAP M1 is coming out. In my example, so I'm going to take my I'm going to change my 110 to 120, okay? And I'm going to say that is taken in GAAP expense over 2 years at $60 per year. So year one, GAAP is going to have a $60 expense that we don't get for tax. In year two, we have a GAAP expense for $60 that we don't get for tax. So we have an M1 in year one and year two, that's a $60 add back. Because according to this, economic performance for tax does not occur until paid. Okay, we haven't paid him anything. So we get to year 5, it's now worth $100, or worth $500. He exercises it. We now have a $500 or $400 W-2. GAP's already taken the expense. So in that moment, GAP's not going to take an expense because it already has. It's fully done it under the Black-Scholes methodology. So now, we now have a $400 M1 for tax that's a reduction in income by virtue of paying them. Okay, so now this is worth knowing. Okay, and I didn't even know I was going to do this. But knowing things, especially when you're going to hear a term called, let's see, I'm going to assume a 20% tax rate. Okay? And I'm going to assume that we gave Jackson 4 shares. Okay? So what happens is, how much was your income, Jackson?
It was 400.
400, okay? So 400, Jackson, 400 times, what's my tax rate?
20%.
20%. What's my tax? Fuck.
50.
It's 80. Did you say 50?
Yeah.
You know, I say stupid math all the time, too.
Sorry, the 10 keys.
So, I was hoping my math was going to work a little bit better here, but it's not going to. There's something, this is called the cashless exercise. And you might hear this term. The only reason I'm bringing this up, you actually might hear this term. Okay? The cashless exercise. So, we ran something through your W-2, Jackson, and it's going to result in $80 of income. Where's that cash going to come from? Are you going to cut a check to the company for $80? Nope. Probably
It's
not.
my own, whatever.
No, it has to go through your W-2.
Right, but
So
how am I going to pay the tax, you mean? Or?
No, Let's has to send $80 to the IRS
Oh, yeah.
when they give you the stock.
I withhold it. On the
From
W-2.
what?
There's no cash, though.
There's no cash. Where's that cash coming from?
would it be my active like wages?
Nope. Because we pay you $1.50 a day.
Okay, so
Okay.
enough.
I mean, generally, this exercise is going to way outpace
Okay.
what's going on your W-2. Okay. So what we do is we say, look, man, we're going to take 1 share back for tax and leave you with 3 shares. So now we were required to send the IRS $80, but we took out $120 because we gave you 4 shares. I should have made it 5 shares. I'm an idiot. And now we're going to use one of your shares or some level of shares to fund the withholding that we have. Okay? That's how that's done. It's called the cashless exercise. Got a question, Carter? You look intellectually curious back there. Okay? So deferred compensation, Jackson's able to say, I earned $500 this year, put it away, I'll get it when I'm 59 and a half. When he turns 59 and a half, he gets his $500. We withhold the $100 or $80 from that amount. That's how that works. He gets paid. We actually have a cash source to withdraw from. That's how that works. ISOs, I hate ISOs. ISOs were really, really, really big in the 1990s and then early 2000s. And so we're going to grant an ISO of $100 to Allie. You know what ISO stands for, Allie? It's called an incentive stock option. Okay? And so we're giving you an ISO or an incentive stock option, Allie, for $100. And one of two things is going to happen. And this is where I say, what did I say about Googling? Googling is a good thing. So what I'm telling you is 80% correct. Can you do any better than me on ISOs?
Not even close.
Okay? I hate them. Okay? ISOs, there's one of two options. Okay? There's qualified exercise and there's non-qualified exercise. Okay? A qualified exercise means that I issued you something $100,000 or less of an ISO, which we have $100 up here, and from the date you're granted that ISO, you can't exercise it for a period of 2 years from either the date of grant or date of exercise. I can't remember which. I think it's date of grant. So again, everything I'm telling you, there's 2 answers, Chris?
Correct answer.
And I'm in the I don't know category right now. I'm telling you what I think I know. And by the way, when you're interacting with a client or a manager or whoever, starting with, here's the stuff I do know, because that's what I'm doing right now. Here is what I think I know. I don't know that I know it, but here's what I think I know. I think I know that an ISO from date of grant, not date of exercise, as long as you hold it for a period of 2 years, it falls in the qualified bucket. If you exercise or dispose of that ISO within that 2-year window, I think from grant to date of exercise, then it's non-qualified. So non-qualified is exactly what we just talked about for options. So a non-qualified ISO exercise has the same tax impact that we just talked about for non-qualified options. Exactly the same. With a qualified, here's the thing. You have regular tax and you have AMT. Max, what does AMT stand for?
Alternative minimum tax.
How do you feel about that, Chris? You think he's right? Allie, is he right? Perfect. I love it. She said, I don't know. Alternative minimum tax. What's that? If you're going to explain to Allie, your peer, what alternative minimum tax means, what's that mean?
It's like a floor on the effective rate of your tax if you're in the high enough tax bracket.
Say that again?
It's like a floor on your effective tax rate.
Okay, since I know what you're talking about, that's not a terrible answer. But Allie is no better for that answer, I don't think. Okay? I don't think. Did that help you at all? The sureness of your voice leads me to believe that that's not right. Okay? So regular tax and AMT. Okay? There's income, I'm going to say, of taxable income of 100 and 100. Okay? So what happens, you go to the form, and by the way, this has become way less of an issue since the Trump tax cuts in 2017. Because the fact that you don't know this was much more prominent of an issue prior to 2017. What this does is says, all right, you have income for both, and under the old rules, okay, pre-Trump tax cut, Allie, do you have an idea what the SALT cap, state and local SALT cap max amount is? Carter?
10,000.
10,000. Okay? We have a $10,000 cap on SALT. But prior, it could be way bigger. Okay? So we say, okay, I'm going to revise this. We have state and local deduction because I have a California house. Okay? And my taxable income, let's see, ISO. My taxable income is 60. Okay? So now you have this regular tax calculation. The punchline where I'm going with this is AMT is a parallel tax calculation. So when Max says we're searching for a floor of the tax to be paid, that seeking of the floor is by virtue of two tax calculations being performed at the same time. And you take the greater of the two. Okay? So if I take this times 30%, that's $18 of tax. But now for AMT purposes, so you see I got ISO at 0 here. So an ISO that falls into the qualified tax or qualified option results in 0 taxable income for regular tax. Well, that sounds nice, doesn't it, Max? Oh, it does. Okay? But for AMT, they say, it's $100. So now I got to go from my regular tax calculation column to do my second tax calculation column to figure out which is which. So now I have $100 of income. I get 0 deduction for state and local. And then I have $100 of income because of my ISO, which gives me $200 of AMT taxable income times, and I'm going to say AMT comes in at a lesser rate. It's not, they use a different rate system of 20%, $40. So under the AMT calculation system, there's $40 of tax. So now I've found the floor that Max was referencing. So when you look at the 1040, the 1040 is going to say regular tax of 18, and then it's going to say AMT tax of 22 to get to the 40. So my AMT tax is $22 because it's the variance in between my regular tax and my AMT tax. So there's two taxing systems. So for non-qualified stock options, we have this cashless deal, can't deduct it till paid. ISOs, Google it, because I kind of gave you what the boundaries are. I can't remember what they are. They were very popular in the 90s and 2000s until the tech bubble crashed. And everybody that paid AMT, they took their $100 and the tech bubble crashed and it was worthless. They said, why the hell did I pay AMT when I didn't get $1 out of this? What just happened to me? They fell out of favor due to the 90s or 2000s. Deferred comp, not deductible till paid. Let's see, Allie, who you want to call on? Matt. She's sticking with it, Matt.
All right, we have reserves, there's inventory, and economic performance occurs when this is paid and GAAP writes these off over time. Then a warranty, economic performance occurs when this is paid and GAAP also writes these off over time.
Yeah, well, okay, so let's just stick there for a second. Okay, anytime there's a reserve, generally it's not going to be deductible. The only industry, there's two categories where reserves are deductible. One is insurance companies, and the second is banks. I think banks. I don't know. I'm sure insurance companies. Okay, how many banks and insurance companies do we do, Brett?
I think 0.
I would go with 0. The banks, I think we do some banks. But I'm sure we don't do any insurance companies. At least the insurance side of the insurance company. Okay? So reserves, anytime you see a reserve, your default, your starting point should be it's not deductible. Okay? Matt, who you want to call in?
Let's go Connor McCraddock.
Letter H, change of accounting, 481A adjustments, positive adjustment written off over 4 years, negative adjustment written off in the year of accounting change.
Okay? So we talked a little bit about this yesterday, right? That said if we change a method of accounting from cash to accrual, I'm gonna do it two ways. I have AR of $100, equity of $100, okay? And this is on cash method. Max, since we're on cash method, how much have we paid in tax? 0, because we haven't collected the cash. Okay, we do a 481A adjustment. This says you have to quantify what amount we would have been taxed on if we were on the accrual method and compare it to what we have been taxed on the cash method. How much have we been taxed on so far, Connor? On cash basis? 0. How much would we have been taxed on accrual?
100.
100. So this says you have to take that variance in between those two amounts, divide it over 4, and report it over 4 years. Okay, so now we're going to have year 1, 2, 3, and 4 of 25 per year, correct? Okay, so what this is saying, if we do that, now we have a $25 M1 that's going to roll through our tax return over the next 4 years because we did a change of accounting method. Okay, so now let's change the facts a little bit to say this is AP. What's the rule up there say? Well, the cash basis. How much deduction have we taken, Connor?
None.
None. If we were on the accrual basis, how much would we have taken?
100.
So now we have to do the variance, correct? So what's my variance?
100.
100. So what's my rule say? A negative adjustment.
Written off in the year of accounting change.
Written off in the year of accounting change. So we would have one M1 in year 1 of $100. And you will see 481A adjustments as an M1 on your tax return. Not often, but do you see them? Every once in a while. Oh, fuck. Okay. Matt, who you want to call on?
Let's go Carter.
Carter, what's this say?
Deferred revenue, year 1, to the extent that deferred revenue is recognized for financial reporting, it is also recognized for tax. The amount not recognized for financial reporting can also be deferred for tax. Year 2, the amount recognized for financial reporting is recognized for tax. The remaining amount is deferred for financial reporting, or the remaining amount that is deferred for financial reporting is recognized for tax. Stated another way, 100% of the deferred revenue is recognized for tax purposes in year 2.
Does that sound right? Uh-oh, you look like you have a furrowed brow. He might have busted me on something.
No, the wording was interesting, but I think the last sentence got it right.
Okay. Well, fire away, man. I mean, anytime you want to interject, that's why you're here.
Yeah, it's just
You're a translator for the old guy.
basically if you try and defer revenue for financial purposes past 2 years, you can't do that for tax. You have to take it all by the second year.
Okay. So, again, we talked about yesterday, if we had $100 of deferred revenue, GAAP recognized, or 900, it was 900, right, Jackson?
Yeah.
900 is what we said. And GAAP recognizes 300 over a 3-year period. In year 1, GAAP recognizes 300. For tax, we have a 300. So let's do it in terms of M1 just to make sure we're all on the same page, right? There's 900 of deferred revenue, which really turns into 600. 900 of cash, 300 of equity, because my P&L is 300. So this is cash, because deferred revenue is debit cash, credit deferred revenue, equity. We recognize 300 for GAAP, right? So my M1 in this year is 0. Okay? This is year 1. Year 2, it says my P&L is going to be 300, correct? Because now we've recognized 300, 600, 900, correct? But I'm going to have an M1 of 300 because I have to recognize the full amount. And deferred revenue has to be recognized by the end of year 2. And when you have these multi-layers of deferred revenue year 1, deferred revenue year 2, deferred revenue year 3, this turns into a reconciliation process that you as a preparer have to confront. Is that fun, Brett?
No,
No.
it's hard to figure out the buckets.
So would the remaining 300 have to get dispersed by year 3 then?
Okay, so
For
yeah,
deferred
you know
revenue?
what, that's a great question, Connor, because year 3, you're going to have 300 for GAAP, but by virtue of recognizing the year before, you get a deduct for tax because GAAP is over-recognizing in year 3 because we've already recognized everything in prior years. That's a great question. And that was a failure on my part to be paying attention. Can you pass that back, please? Oh, fuck, sorry. Okay, this is going to be a guided tour because I don't remember what the hell that I did here. So I'm going to be guessing just right along with you guys. But what I think I'm doing is I'm saying I'm probably, don't throw pitchforks and spears at me if I'm wrong, is I have a 2021 balance sheet, 2022 balance sheet, maybe somewhere in here is an income statement, maybe, that says at the end of last year, or the beginning of 12/21, 125 of cash, $1 million of cash, account receivable. I have deferred revenue on here, yay, me. I like that a lot, okay? So this is the balance sheet of the client that you're gonna get when we prepare the tax return, okay? I think is what's happening here. And we have, oh, look at this, we do have an income statement. We have revenue, cost of goods sold, wages, depreciation, inventory reserve, bad debt, deferred comp, okay? So I'm presuming, okay, so this is the same thing. This is saying that the next page you might want to write because I was not smart enough to do it. This is a cash basis taxpayer, is what this is. And now we're going to quantify what the M1s are for the cash basis taxpayer, okay? So when the process of doing this is you're going to start with, okay? You're going to start with, I don't like this, book income. Come on. Okay, let's go over here then. You're going to start with book income of 615. Okay? Book income 615. And going back to what we talked about yesterday when we said we were talking about cash-based taxpayers, in year 1 we had $100 of receipts, $100 P&L, and we were able to back all that out, correct? Because it was year 1 activity. But year 2 activity, we went through and demonstrated, well, my AR at the end of year 2 was 20, and my cash at the end of year 1 on my balance sheet was 10. Do you guys remember this from yesterday? And it demonstrated that by fluxing the beginning and ending of the account is this year's M1 because that's this year's activity, okay? So the procedure for a cash basis taxpayer is, well, my beginning AR from the end of last year was $1.5 million. So conceptually, I know the procedure is I got to pull out my GAAP accounting in the process. Then I got an accounting method. Then I got to put in my tax accounting method. So I'm going to back out the $1.5 million of GAAP AR, or add back, excuse me, I'm saying that wrong. So let me do that again because I was about ready to do that pretty poorly. Okay? So, Matt, who you want to call him? Because I know they're going to come to you if I ask anybody.
I'll do it.
Okay, so, Matt, at the end of last year, 2021, I had $1.5 million
Yep.
of AR.
Yep.
Okay, and I really was going to do this really, really poorly, so now I'm glad I stopped myself. Okay, and I have a 30-day collection cycle no matter what. I don't have any bad debt, even though I have bad debt. We're going to pretend it works like clockwork. So December 31st of 2021, I had $1.5 million of AR. On February 1st, how much AR do I have left of that amount from year end?
The $1.5 million?
Yeah. Did I collect it all?
No.
Yeah. Well, I said 30 days.
Yeah.
So in January, I collect AR 30 days. Okay. So I've collected 100% of that AR because I do it in 30 days. On a cash method taxpayer, does that result in taxable income?
If you collect it, yeah.
Yes. So I take last year's AR and I add it back to my 615 because I know I collected it within the first 30 days. But I also know at the end of the year, I got $2 million of AR. That means I'm on accrual basis for that number. I didn't collect it, and I back it back out. So this results in I collected $1.5 million, but I reported $2 million in it in my P&L, which results in a reduction to that 615 of $500,000. Did that make sense to everybody? Okay. Bad debt's its own reserve either way. Okay. On a cash basis, there is no concept of bad debt because you never reported it through your income. But if you're taking that through your GAAP P&L, it's still an M1. Okay, so my beginning bad debt, my ending bad debt, you flux it. Inventory reserve, it's a non-cash item. AP, Matt, do you see the reverse, or can you articulate the reverse for the AP if I pay all my AP within the first 30 days?
So at the beginning of the year, you had 400,000 in AP. So you're gonna take that out of your book income, and then at the end of the next year,
Why? Because you actually paid it, right?
you actually paid it during
Yep.
that year, and then for the current year, you have 500,000 on the balance sheet, but you haven't paid that, so then you have to add it back to your
Yep.
book income, and then the net of the two gives you your M1.
CV, how you feel about this? Clear? Allie, clear? The other Connor, clear? Okay. Okay, so it's the process of fluxing the accounts or checking the variance, and the thing that is probably going to be hard, potentially, is going, okay, wait a minute. On the AR side of things, the prior year balance, Jackson, is a negative or a positive?
For,
The M1. The AR is an add back?
oh, the AR? Yep. Okay, so we're adding the beginning balance.
You're
to
adding
our
the
book.
beginning
Yes.
balance. And the ending balance, are you adding or subtracting?
We're subtracting it.
Okay. So is that the same thing we're doing with AP?
It's essentially the opposite.
It's essentially the opposite. So knowing the signs and why the sign's there in the M1, that's something that would be useful to know. Because, wait a minute, I'm flexing the account. Well, but exactly how are you flexing the account? You have to be smart enough to go, for the AR, it's an add for the beginning and a deduct for the end. For the AP, it's a deduct for the beginning and an add for the beginning, or a deduct for the end. Well, no, I said it backwards. You get my point, okay? Knowing how that works and why it works that way, because I collected the AR within the first 30 days, therefore I have to add it back. I haven't collected the end, therefore I have to deduct it from my P&L. I paid the beginning AP within 30 days, therefore that's a deduct. I haven't paid the AP on the balance sheet at the end of the year, therefore that's an add. Knowing that distinction probably will be helpful when you're doing your cash to accrual clients. Brett, how many cash to accrual clients do we have?
Quite a bit.
Quite a bit.
The way I think about it is, if my assets go up, my income goes down. So if we look at our balance sheet, our AR went up by 500, so our income is going to go down by 500. And liabilities are the opposite. Liabilities goes up, income goes up. So that's my gut check at the end to see if my accrual cash makes sense.
I think we're still on cash basis. We are. Okay, so this is cash basis year 2, is my point. Let's see, Matt, who you want to call on?
Let's go Sam.
Sam? What do we start with, Sam?
Book income,
Why do we start with book income?
because that's,
The auditors have already ran everything they're going to run through book income, and it's our universe. Now we have to figure out where we account for things differently. Okay? So walk me through each of those M1s just for the hell of it, Sam, to tell me why we're doing what we're doing.
all the beginning AR.
Yep.
So we add our beginning AR to book income because that is things that we paid and in that year and
We collected.
or collected. Yeah, sorry,
Nope,
we
you're good.
collected in that year, and so from a cash basis standpoint, that's when we earned it.
Yep.
And so we add it to our income, and then we subtract our ending accounts receivable because from an accrual basis that decreases it, but from a cash basis, we haven't actually collected it yet, so we can't count it as income.
Yep.
So we decrease our income.
Yep.
Bad debt is, let's see, beginning 75. So did we actually write it off as uncollectible? Then
So let's talk about that. That's an interesting phrase. You're hitting the nail on the head. So going back to accrual basis taxpayer, going back to my $100,000 worth of AR, I do a reserve for $10,000, and I know I'm not going to get it, right? I don't know who it is. That's not deductible for tax under accrual method, correct? Accrual method tax accounting. But if I say, hey, I know Brett's not going to pay that, okay? I specifically know he's not going to pay it. So I can now write that off because it's specific, and I actually take it out of my AR, okay? And now that is a deduction for tax. So, but now let's look at that through a cash basis perspective. Did you report the $100 of AR because you're on cash basis in my example? No. So bad debt reserve, up or down, doesn't matter. Because even though I know I have a reserve against it, well, I didn't report it to income to begin with. Okay? If I specifically identify Brett's not going to pay me, I never reported his income to begin with. So that reserve from a cash basis perspective is almost meaningless other than the auditors are booking a bad debt reserve in the P&L. And we have to take that bad debt reserve out of the P&L and just push it out. That's the only reason we're doing that.
so we're just taking what they gave us and saying, okay, sounds good. We'll do that.
We're going to flux it every year. There's no analysis or thought process with respect to, do we have a specific write-off? How does this work? What's going on? That kind of thought process goes with the accrual method counting. Okay, so that's just truly is, what was my beginning? What was my ending? Who cares? Because again, I don't report the reserve. I don't report anything in AR. This is not from tax perspective, income tax perspective. Therefore, my reserve, up or down, shouldn't affect my P&L either way.
Would it be similar for inventory reserve, or is that?
No, an inventory reserve would be different, because an inventory reserve from from cash based perspective, you know what? That's a nuanced question and it's a nuanced question because I can't remember the income limit. Under a certain dollar threshold, you can write off inventory as if it was a supply. Over a certain level, you have to go to the accrual method. Do you know where those boundaries are?
No.
I can't remember where those boundaries are. Okay, so if this were truly written off, then yeah, it would be the same, 100%, because we've already written off 100% of it. So we're going to go with that answer, and I don't know on top of it. Okay. Okay. So what's next?
Accounts payable. So we are going to subtract out our beginning accounts payable because those are things that we paid this year. So it decreases our income. And then we're going to add back our ending accounts payable because we didn't actually pay the cash for them this year.
Correct.
And then accruals. So how would that work from a cash basis standpoint? Because like, do we have cash moving on an accrued vacation expense? We don't, right?
Nope.
So is this another one where we're taking what,
You
we're just
take-
flexing it?
Yep.
Okay.
100%. 100%. Deferred comp, same way. Deferred revenue, the same way. Because deferred revenue, there is no concept of deferred revenue for cash basis. Because as soon as we receive the cash, whether we perform the service or not, Sam, do you think we have to pick it up?
Yeah.
Yeah. For deferred revenue, do you think we get a deferral into year 2 the same way we do for on an accrual basis taxpayer?
No.
Why? Because we receive the cash. And by definition, we are a cash basis taxpayer. So if we collect cash, income. We pay cash, deduction. So on deferred revenue, you now have to take it into income. Carter, how you feel about all this? Clear? Allie? Clear? CV? All right. The back row always are the people that sleep. I kind of like this. This I put together to say, you know, to tie back a little bit to the accrual method of accounting, and we had the 3 prongs. Nally, what were they? Sorry, I caught you mid-drink.
Sorry, say that again.
What were the 3 prongs to measure whether something is reportable for income tax purposes under the accrual method?
Wasn't it like?
Call a
something
friend.
like
Phone a
all
friend.
events?
Yeah. Do what?
That's all I remember.
What was it? Sorry, I thought you were going to phone a friend.
All events have occurred. The liability can be determined with reasonable accuracy, and then economic performance has occurred.
Okay, so that's what this is. Okay, this is kind of a summary of what that concept is. You know, for cash, you really don't need to talk about it. For AR, is it reportable when the good or service is rendered, economic performance has occurred? Allowance for doubtful account, good or service, no. Economic performance is when you have a specific write-off of the AR. Inventory reserve, no. Good service rendered, but specific write-off of the inventory. Accounts payable, good or service rendered. Economic performance, yes. Credit card payable, yes. Oh, here's something that's, take your highlighter, highlight credit cards payable, and remember this rule. Okay? Because I'm switching from accrual basis for a moment to cash basis. If Lutz does service for me and they send me an invoice and I book that in the AP, is that deductible for cash basis? No. If Lutz sends me a bill and I pay it with my credit card, but the cash hasn't left my account because it's on my credit card, is that deductible for cash purposes? Yes. It is. So that is a liability for cash purposes, even though it's a liability that your cash has not left the building. Credit card payments for cash purposes are deemed to be cash payment for cash method accounting taxpayers. Okay? I meant to bring that up earlier. Accrued vacation, no, but you have the 3.5-month rule. Accrued compensation, 3.5-month rule. And this is another place that you might want to get out your highlighter and give yourself a little bit of a note, because this is one that drives me nuts and we ignore it, and I think we do ourselves a disservice and the client a disservice by the virtue of what we ignore here. Okay? Amounts paid by 3.5 months. So I'm going to push that aside for 1 second. I am relatively confident that everybody in the room probably maybe has heard of Enron. And I think everybody in the room probably either studied Enron, ethics, or otherwise in college. Maybe, maybe not. Okay? So, I hate this. Bad actors create lots of problems. Okay? Matt, who you want to call on? Max. Earlier I said, when is deferred comp deductible?
Deferred comp when it's paid.
When paid, okay? So, you gotta love this, okay? Enron. Enron took the deferred comp rules and they abused it so bad that they created a new regime. Or, I think it was new, I don't know. I don't know how new it was. I don't know if this was a bolt-on or whether this was brand new. 409 Cap A. 409 Cap A is deferred comp rules. Okay, and what Enron did, okay, was they said, okay, Max, we are going to give you $10 million this year as W-2. Do you want all of it? No, I'm good. I don't want to pay tax on it. I want to put it into a deferred comp plan where I can take that out starting at age 59 and a half over a 15-year period to where it funds my retirement and my tax rate I'm not going to choke on my tax rate. Okay, so people were stuffing lots into the deferred comp plans at Enron. So Enron was a shell of a company, but nobody really knew it. That it was a shell of a company. The shit that they were doing. Has anybody read the book? Conspiracy of Fools, and I mean the shit that they were doing, it was like, holy fuck. Okay, so now Max has $10 million in this deferred comp plan. So there needs to be, well, we agreed you were going to take it out 59 and a half, right? Well, there's this, now we got to put a barrier. You know, you can get it out earlier, but there needs to be a barrier. And that barrier is, if you take it out early, Max, we're going to take away 10% from you. Okay? So, you get it out, what's 10% of $1 million?
1 million.
How much do you get of cash?
9 million.
9. Okay, so everybody at Enron knew we were on a sinking ship. And everybody knew that I don't know what the real number was, whether it was 100 million, don't know, but let's call it $100 million. So they said, I'm going to take my 10% haircut, because if I don't take my 10% haircut, I get nothing. So now $900 million exited Enron to their stake, the deferred comp holders, while the shareholders and all the 401ks just were experiencing an economic bloodbath. And Congress said, oh no, that's not good. So what they did was put in 409A to say, okay, if you Max put something in deferred comp, then we're going to pin you down on the rules. And if you violate those rules, Max, we're going to take you out back and beat you around the head until you're bloody. And what they said was, you tell me the exact moment in time when you're going to take that out. And first of all, the first rule is, do you want your $10 million? And it's December 31st. And you say, nope, I want it in deferred comp. Versus, do you want your $10 million from last year on January 1st? One is a good deferral for deferred comp, one is a violation. Once you have to make your election to defer comp by the end of the year, okay? So we're going to pin you down. You got to cross every T, dot out every I, and if you don't, guess what? We're going to not punish the company, Max. We're going to punish you. We're going to make you pay tax on it in your discovery. We're going to charge you interest and penalties, and we're going to charge an extra penalty of 20%. So now your $10 million turns into $2.50 by virtue of all the interest, penalties, and tax that they're going to levy against you because you were a bad actor and took it out at the wrong point in time. Okay? So why am I bringing this up? This is so fucking stupid, I don't know what to do with myself. Is that there's, that up to and including what we just described for Max, there is something called in the money options. Okay? So going back to Jackson, we gave you an option for $100, correct?
Yes.
Okay? So your option was 100, but if the fair market value, Jackson, was 200,
Yep.
that's an in-the-money option. An in-the-money option falls into this deferred comp. That I kind of get. Fine, fair enough. But the one I don't get is short-term deferrals. Short-term deferrals. Okay? So let's go back. This is a long way to get back to here. Okay? Amounts paid by 315. What 409A says is that if you don't pay your bonus, if you pay your bonus after 315, guess what you have? A short-term deferral. And the IRS could come in and say, you had a short-term deferral. Now, Max, you're an employee of Lutz. We give you a $10 million, $5 million bonus, whatever the number is. We pay it by 316. Does Lutz get punished? You get punished. Okay? So and we ignore this, right? I mean, we need to say out loud to partners, managers, clients, that this 315 short-term deferral, while the IRS has never pushed it that I've ever seen, because it's so ridiculous, the rule does in fact exist. Okay? Deferred comp, goods and services, no, only in payment. Deferred revenue recognized over 2 years. I tried to take the things that we talked about as from an economic performance, the three-pronged test and put it on here in something that might be meaningful, maybe. So I don't know if you guys want to put a post on that page or you care, but that's what that is. Okay, so I think this might be accrual method, M1s. Jackson, what do you think about this? Where do we always start when we're doing our M1 calc?
We always get our book income.
We always start with our book income because book income has every GAAP accounting method in there to quantify what that number is. Now we have to figure out what our tax accounting method, different accounting, tax accounting methods that are different to arrive at the variance to arrive to taxable income. Okay? So what's that first one?
Looks like we're adjusting the bad debt.
Yep.
And it's like we talked about, we're just fluxing the accounts or whatever, beginning and ending.
Yep.
And then looks like we're doing the same thing with the inventory reserve.
Yep.
And then, yeah, same thing down to the deferred comp we're doing.
Okay, so but let's talk about accrued vacation though. Right? That's the one that I didn't do it here. Might have been lazy, might not have remembered. I'm not sure which it was. Both are equally likely. Is that this is the one you might want to make a note on your page that you divide this by 12 times 2.5 to maximize what the taxpayer's deduction is. And do we do that commonly, Brett?
Yeah.
Except I'm stupid and I didn't do it here. Right? So let's see. Accrued compensation. I don't think that's right. I think I'm just catastrophically stupid. I don't know why I put that on there. That shouldn't be an M1 at all. Because accrued compensation is something where everything has been fixed. And tell me if I'm wrong, Brett. I think I just was being stupid here. Everything's fixed. The service has been rendered. I don't think there's a moment in time I've ever taken, except maybe sitting at my counter watching football, accrued compensation as an M1 I would flux. Put a big fat X in that one. That should not be there. But the accrued bonus is one that says, okay, is that paid within 3.5 months? Deferred comp, not until paid. Oh my. Recognized for book 2022, ending deferred revenue, 2 million for 500,000. Where the hell is that M1 coming from? What's my deferred revenue up there? 3 million? Well, I'm not flexing that account. Happens to be 500,000, but that's a fluke. Oh my. What is this? Okay, so this is deferred revenue. I hate deferred revenue. Okay? So I'm pretty sure, and I think I probably did this poorly. As a matter of fact, I'm quite confident I did it poorly. The top section is my GAAP accounting. And going back to what Austin Sabalaska said yesterday was, talk to the auditors. Ask them how they're recognizing that for tax. Okay? For tax purposes, it's well, you recognize whatever in year one and the remaining amount in year two. So for deferred revenue, in year one, I have 2 million that I'm recognizing over 4 years. Year two, over 4 years. Year three, over 4 years. Year four, why the hell I used 666,000, God only knows. Have no idea. Okay? So the rule says that I have to recognize an amount for tax equal to what was done for GAAP in year one. Okay? And what year are we in? I assume 2023? Maybe?
We're in 22 at the top.
Might be.
22?
Yeah.
Okay, so it's 22. Has to be. Okay? So for GAAP in 2021, we're reckoning the 500 and 500, right? For tax, we have to recognize the remaining amount from the previous year of $1.5 million. So for tax, I got $2 million of recognition for tax purposes. For GAAP, I have 3 tranches that are being run out for $1.5 million. And God willing, I hope that ties out to what my M1 schedule says. I got $1.5 million that I recognize for GAAP because I got to back out my GAAP treatment. I have $2 million for tax that I have to recognize because it's whatever the GAAP amount was for the current year plus whatever the previous year's deferrals that are remaining to be recognized at the end of year 2. And these schedules are terrible. I mean, you really for scooters, the gift card calculation on that, I spent 2 hours in Katie Bird's office saying, how the hell does this work? Tell me what you're doing for GAAP. And on that one, they had the reloading of a gift card. I'm like, what the hell are you doing to me? So, going back to my schedule, okay, they would say, you know what? Even though I got this $1.5 million recognized for GAAP, I know of this 2019 line, there's 500,000 still out there, and I get to 2023, there's 0 out there for GAAP. But I know that, Allie bought a gift card and she dropped it in her car seat in between her seats, and she can't get it, and now that card's unused, or it got thrown into a drawer somewhere because nobody really wants a card, or I got the training, I really don't like scooters, so it's left in my car, whatever, okay? There's an amount that's unused in there. And what they were doing was harvesting that amount unused and reloading it on new cards. So now this amount that is loaded on new cards has been recognized for tax, but it looks like a new addition. I hate deferred revenue.